Okay, folks, so this should be quite the week indeed. We've got futures down deeply as of the time I'm shooting this video, oil up almost 6.6%, crypto getting bludgeoned, and we've got three big things to get ready for this week. Number one, earnings are coming out for many popular retail stocks in the small to medium cap markets. Which ones are going to be reporting and what do you need to know? Number two, a big Fed catalyst that's going to be happening this week and what you need to know about it. And lastly, but most importantly, the latest on this Ukraine-Russia situation and its implications on the market. We'll put the timestamps below, but let's get right into it. Okay, so let's go ahead and start with earnings. So Monday, most notably, we have Lordstown, Lucid, Zoom, Blink, 3D Systems, Smile Direct Club, and Luminar. With Lucid, we are looking for updates on demand. They are trying to scale up to mainstream production. We need to see, number one, and most importantly, is demand holding strong? Is it increasing? Number two, can they actually fulfill on demand? How is their supply chain looking with all these new complications? Are they going to be able to meet deliveries? We need some information that suggests on profitability, at least unit profitability. How much are they making per unit? Obviously, the overall picture is not going to look profitable, but we want to start looking at unit profitability. How much margin are they building for each vehicle? Lastly, we're going to be looking at overall expenditure. Lucid raised a substantial amount of capital via debt offering back in December, and they have a lot of money to operate the company for the next couple of years at least. But investors are going to be looking at how much they're spending, how much they have to invest to keep their supply chain operational. The less they can keep expenses in check, the more that we have to worry about another offering coming down the road via share offering or debt offering. Next, you got Zoom. Now, you know that I'm not a big fan of Zoom. It's hard for me to understand what makes them competitive outside of their brand name, which everybody knows. But at the same time, I do believe they have some staying power in their niche, while also being down 75 to 80% from highs. It's going to be very, very interesting to see how Zoom reports with an increasing competition in its market, at the same time as that market getting smaller and smaller as people go back into the offices. Now, I think over the long run, you're going to see that trajectory of that market where people are remote working actually increase. But obviously, that acceleration that we saw in the pandemic was in and of itself temporary. So it will be very, very interesting to see how Zoom is doing. At a certain point, if it keeps getting beat down, it might be a very, very good deal, even if you're just buying the brand name. We've seen a lot of examples of stay-at-home stocks, which people have shorted as a hedge against inflation, start beating massively on earnings in the last couple of weeks, like your Etsy, your Square, your Carvana, and your CarGurus. Obviously, they're not really super related, but they all are considered stay-at-home hedge fund short stocks to protect against inflation, and all of those dramatically beat on expectations, which caused them to do a little rally. One of the issues of blanket shorting of stocks as a hedging maneuver based on just simple characteristics like, oh, did it do well in the pandemic or is it a tech stock, is that obviously you're going to get yourself into the situation where some of them actually perform very, very well and you get a little squeezy McSqueezy. I'm not suggesting that that's going to be Zoom, but the expectations are going lower and lower and lower, and eventually Zoom is going to beat those expectations. Moving on to Tuesday, you have Target, or as I like to call them, Target, which is a designer way of saying it. It makes it sound expensive. You've got C. Baidu is one of the most notable Chinese tech stocks. I don't really care too much about that one. You've got Workhorse, AutoZone, Kohl's, and then after, you've got SOFI. This one, you want to focus on members. Right now, a lot of fintech companies are seeing a reduction in member growth. I'm thinking you do see some of that effect hit SOFI, but the question is how much are they growing compared to their competitors, and how much are they retaining their members? We just had a Super Bowl at SoFi Stadium here in my hometown of LA. Do they expect any impact of that? Because that's obviously a very, very expensive form of advertising. We're also going to be looking at how well they're able to monetize the members that they already have. How many products are they cross-selling their current membership base? If somebody has a SoFi savings account, are you also selling them the ability to invest with SoFi? Are you selling them the ability to get a credit or debit card? Are you selling them the ability to get certain loans? How much utilization of different products are people participating in? And what is the new guidance with that bank charter and how that's going to impact SoFi throughout this year? Next, you have Ooga Booga AMC. AMC still has a very, very dedicated following despite the overall risk-off environment punishing literally everything. We'll see how AMC reports on a fundamental basis. Plug Power, Salesforce, Wish, BNGO, Nordstrom also reporting. Keep in mind that on Tuesday, you also have NIO, XPEV, and Li reporting deliveries, representing the main three luxury EV manufacturers in China, outside of course, Tesla, but I mean domestically based EV manufacturers. Cathie Wood and ARK have been buying XPeng as of the last couple of months, which I don't know if that's a good thing or a bad thing for XPeng, specifically considering how she's recently flipped on other stocks like Palantir. But still, Wednesday, you've got PaySafe, Dollar Tree, Snowflake, very important SaaS company. You've got a Zip favorite, ChargePoint. EV sales as a whole whole have been exploding, and I expect a trend of EV adoption to accelerate dramatically in the upcoming years. And likewise, it's my view that with more electric cars, you're going to need more charging infrastructure. From commercial lots to residential, there should be a dramatic rise in demand, which should cause charging hardware and software sellers like ChargePoint to do very, very, very well. We'll be watching this one very, very closely. You've also got C3 AI, Coupang, and Splunk. Now on Thursday, you have Best Buy, Kroger, Billy, TD Ameritrade, Burlington, Big Lots, Costco, Broadcom, Gap, Duolingo, and that's really it for the notable earnings. We certainly have a lot of retail heavily watched stocks reporting this week, many of which have dirt low expectations priced in. So the bar might be set pretty damn low for them to beat. We'll see what happens. Okay, next, the Fed catalyst. So on Tuesday, you have central banker Bostic speaking. Then on Wednesday, you have Charles Evans and James Bullard. And finishing that off on Wednesday is Jerome Powell himself. He'll be testifying before the House panel on Wednesday and before the Senate on Thursday. Now, the reason that this is important is because markets have taken the Russian invasion of Ukraine as a hint that the Fed may be less aggressive at hiking interest rates, especially in next month's FOMC meeting. And so far, the Fed, at least as much as I can tell, hasn't really given much of a public opinion in regards to whether their perspective has changed. But these speeches will give them the opportunity to. On one hand, sanctions are already dramatically increasing inflationary pressures. Just look at oil right now. On the other hand, some people think the uncertainty is going to hurt demand. Now, central banker Charles Evans, who again is speaking on Wednesday, is regarded as one of the more dovish members. He recently said that he sees no need for extra restrictive rate hikes, like the kind that caused recessions 40 years ago. Now, Bostic is a bit more in the middle on this, but he has been a little bit more specific about addressing the Ukraine situation. He said events today in the Ukraine are on all of our minds, and we'll be watching this closely here in Atlanta and across the Federal Reserve System to assess the economic and financial impacts. AKA, he's acknowledging that the Fed may have to reassess and pivot if necessary based on the outlook of the situation, which is also saying a lot because it does suggest that the Fed is going to react to this problem, whereas some analysts have said that the Fed isn't going to react. Of course, it does not address the question of how they're going to react, but perhaps we'll hear more at his speech. And then, of course, you have hawk James Bullard. He has suggested in the past that he supports a full point rate hike by July. We haven't seen much of an update from him in this Ukraine situation as it's escalated, but we will this week. And keep in mind that these conversations from very, very influential central bankers are not just coming during a huge new black swan event, the Ukraine invasion, but also before the employment report on Friday and the latest oil production report on Monday. Okay, lastly, but most importantly, Ukraine. It's been very devastating to see the images and news coming from that region over the last week. But in terms of the bright side, it does seem like Ukraine is putting up quite a fight over there, and forms of aid all over the world have flown in. The downside of this, though, is that it does seem that it brings with it the threat of further escalation. And you've heard that Russia put its deterrence forces on high alert, which unfortunately includes nuclear arms. Russia has both a long and very recent history of making up threats to justify increases in aggression. So this latest move certainly does not put much peace to the mind. And if Putin is having trouble with his current maneuvers to take the region, unfortunately, he does have other options at his disposal. Russia Today, which is a Russian government-funded media organization and really a propaganda arm for Russia, reports that Moscow's military is designed to deter aggression against Russia and its allies, as well as to defeat the aggressor, including in a war with the use of nuclear weapons. Putin says Western countries are not only taking unfriendly actions against our country in the economic area, I'm speaking about the illegitimate sanctions that everyone is well aware of. However, the top officials of the leading NATO countries also make aggressive statements against our countries as well. This is what Russian citizens are hearing. We are being hit with sanctions and mean words for no reason at all. Oh, but wait, there are big reasons. But still, looking at their history of making up fake threats or creating fake narratives around threats, it's certainly not a good sign to see the latest rhetoric coming from the Kremlin. Not a geopolitical expert, but that's just my view as somebody who looks at the markets and the global impacts on the markets. In terms of what's going on in the latest news of retaliation from the West, the biggest escalation is with the SWIFT system. The US and European nations agreed Saturday to impose the most potentially crippling financial penalties yet on Russia over its unrelenting invasion of Ukraine, going after the central bank reserves that underpin the Russian economy and severing some Russian banks from a vital global financial network. This is going to make it extremely difficult for Russia to trade with the rest of the world, on top of the other sanctions that have already been put into place. This action is likely to cause a dramatic panic out of the Russian ruble, as Russian rubles get sold off in order to convert convert into other currencies that are seen as more safe havens. Capital flowing out of Russia, people converting their capital from rubles to other currencies like the US dollar or the euro, and an overall cutting off of trade with Russia is going to cause massive inflationary pressures to fall on the Russian ruble. Bloomberg reports that Russians lined up at cash machines around the country to withdraw foreign currency as new sanctions to punish the Kremlin for its invasion of Ukraine sparked fear the ruble could collapse. Right now we're in a situation where the demand for foreign currencies and safe haven currencies, specifically like your US dollar, your euro, and your pound, are going up dramatically, while demand to get rid of rubles is going up dramatically, and the Russian central bank is going to need to print more in order to make up for deficits, which means average everyday citizens in Russia are going to be losing substantial purchasing power every single day that they hold their funds in rubles. What is the value of a ruble if no one in the world will take it and increasingly people at home don't trust it? Imagine you're living in Moscow or St. Petersburg and you hear that the entire world is shutting off your country and global payments are being shut off. Everything from the international network to Apple Pay is now increasingly getting closed off to Russian citizens. What do? Well, you rush to your local bank and try to convert those rubles into US dollars or the euro, but then you find out that everybody else has already tried doing that, and your bank, which is also likely sanctioned by now, has run out of supplies of foreign currency and likely won't be able to bring much in because the airspace is closed. So you're creating this dynamic where this latest round of sanctions is really screwing with the everyday life of Russian citizens. At first, sanctions were directed at those in power in Russia. Now they're directed at everybody. Citizens are going to find themselves completely isolated from the rest of the world. They're going to find that their everyday products are very difficult to come by and very expensive, and they're going to find that their purchasing power to acquire those products has gone down dramatically, crunching the Russian economy, and you're destroying the average citizen in Russia's ability to participate in what's left of that economy. Obviously, very sad for citizens who don't support this war. But when you put pressure on the average citizen, they put pressure on those at the top with the power. At least that's the idea. We'll see how effective this is in practice. Anyways, folks, that caps off this video. Make sure, as always, to keep your eyes on the bigger picture. Right now, there's a lot of different messes on many different fronts. But unless you are an eternal pessimist, there will be light at the end of this tunnel. And that's especially true for the stock market. So keep that in mind and make sure you're making decisions now that will set you up well a year from now, 2 years from now, and so forth. Maybe even 6 months from now. Anyways, if you appreciated this video, make sure to hit that ravishing like button, and also don't forget to subscribe, and I'll see you in the next one.